Hi, everybody. Good morning. Looks like most people have joined us now, so we'll get underway. So, thank you very much for joining us this morning here at the K3 Hub. For those that don't know me, my name is Marie Wadeson, and I'm a managing director here at K3, and I also lead the K3 Hub. I think there's some information on the screen about that now for you. Um, I just thought I'd do something different this morning as by way of introduction. So you might notice, for those that join us regularly, that we have had a slight rebrand here. So this week has been a very big week for us at K3 as we've evolved from K3 Capital Group to K3 Advisory Group and rebranded from both a visual identity and a brand name perspective, which we feel better describes what we're all about here at K3. So, just a few seconds on K3, if you will humour me. So, K3 Advisory Group is backed by Sun European Partners. We employ over 1,200 people around the country who operate across 20 different brands in the group. Those brands broadly fall across the following areas: so business sales and deal advisory, wealth management, financial and restructuring advisory, technology advisory, and business services, which include a range of specialist tax advisory services, financial due diligence and data, and marketing and business development for professional services businesses. So, on to our webinar today. So, this is our second accredited CPD session of the year. A few pieces of housekeeping. So, we are recording today's session, as you've probably seen as you join the webinar. Along with previous recordings, they are posted on the K3 Hub website, which is also rebranded. Q&A function is open, so please do feel free to ask questions as we go along. Preference is that you use the Q&A function to ask your questions rather than the chat, just so that we've got everything in the same place so that Jeremy can knows where he's looking. We've also posted a PDF of the slides into the chat, and I think we'll do that periodically throughout the session for anybody who joins a little later. We are aware that this is quite a long session, and so we will be taking a couple of breaks. They'll be on or around the hour. We're going to run some polls today. They are anonymous and just for fun, so it'd be great if you could get involved in those. So on to today's webinar formally then in that case. So very pleased to welcome back Jeremy Mindell. I'm sure many of you know Jeremy from previous K3 Hub webinars. Jeremy's been lecturing in taxation for over 20 years and is in high demand when it comes to speaking on topics related to tax, pensions, share schemes and remuneration. He's one of the few individuals in the country who is a qualified chartered tax advisor and also holds a certificate from the Chartered Institute of Personnel Development. Today, Jeremy will be covering payroll and benefits reporting, NIC issues, international reporting, day counting and residence, and the foreign income and gains regime. Just before I hand over to Jeremy, just a quick plug for a couple of forthcoming CPD events that you might be interested in. So next Friday, 27th of March, we've got tax issues associated with different business structures. Link to register is on the K3 Hub website. So if you do want to register, that is an extremely popular session. I think I've never seen quite so many delegates signing up for one of these sessions. I think we've got well over 600 people joining that one at the minute. So do get involved if you want. 17th of April, we've got a VAT update, and on the 15th of May, family tax planning and IHT update. Invites are sent out on a regular basis, so do keep your eye on your inbox. And we also promote the events via the K3 Hub website and on LinkedIn. Hope you enjoyed today's session. Wishing you a great weekend. And over to you, Jeremy.
Thank you very much, Marie, and welcome everybody to this session on employment tax as we come up to the end of the tax year and start the very busy reporting season that you have for employment taxes. So, what are we looking at? Well, we're going to look a bit of payroll reporting, benefits reporting, as was said, day count and residence, the FIG regime, foreign income and gains, NIC issues, international reporting, and if we have time, but only if we have time, we'll look at employment of record as well. So payroll, end of year reporting. Now, in theory, that should be very straightforward because you've been doing your real-time information returns each month, I should say, or each pay period. You sort of accumulate it, and that should be the end of the year, and you then press the button, and automatically all of your end of year payroll reporting should appear. Of course, life is never that simple. For a start, you get lots of owner managers of businesses who work out they've done what probably they shouldn't have done, but taken money out of the business and have not recorded it either as paid it as dividends or paid it as salary. And they need to reconcile, make sure that the amounts that they've taken out of the business are reported. Remember that even if they own 100% of the business, and a director or an employee, if they own 100% of the business, which is incorporated as a limited company, that is a separate uh, um, entity. They take money out of it. It needs to be accounted for. So if you've taken £100,000 out, it would be subject to any adjustments. That's 100,000 of salary, and they need to make sure that they've reported it. Because if they take money out of the business which is not reported as salary or expenses or dividends or anything else, then you have a major issue. You've probably got a loan charge. That loan charge means that the company has to pay 33.75% of the amount to HMRC. So let's say you take now £100,000 and you've not reported it, and your year end is 31st of March. By 9 months later, if it's not repaid by the 1st of March, 1st of January 2026, you'd have to pay £33,750 to HMRC. And that rate's going up because the dividend rate's going up to £35,750, and that would only be repaid once the loan is repaid. So it's an area, particularly for OMBs, of some interest on that basis. So reconciliation is important, particularly with OMBs, but obviously we should be doing checks at the end of the year to make sure that the pay recorded is the right pay, that the tax has been deducted over on the right tax codes, particularly if they've changed during the year, and then work through that before producing the P60s for the employees on that basis. The other element is where to report element. So, how benefit is provided. If it is directly between the employer and the employee, between the employer and the provider. So let's say the employer goes to Bupa. There are other providers, of course, available to provide medical insurance. So the employer goes directly. Then it would be a P11D benefit. The advantage to the employee is that there is no primary national insurance contributions on that, but the employer will pay what is known as Class 1A national insurance, which would be at the rate of 15%. So where the benefit is provided directly between the employer and the provider, that is where the contract is, and the provider is providing it to the employee on that basis. And the normal benefits would be cars, medical insurance, cheap loans, etc. Those ones would go on a P11D, unless, of course, you are you are using payroll benefits. In terms of other benefits, if the employee lays out the cash and is reimbursed, what you're doing, if it is a taxable benefit, is you're just giving them extra cash. You can't say, oh, well, because it's allocated towards a telephone or commuting costs or other taxable benefits, we should just put it on the P11D. Remember that if you are reimbursing a taxable expense, so if you're reimbursing a taxable expense, the point would be that the reimbursement of a taxable expense would be a payroll item and should be added to payroll. And you get people who at the end of the year think, oops, I've done it wrong. How do I change the payroll? Well, you probably need to make an adjustment in the final month or month 13 adjustment, and regularize it before the end of the tax year, because otherwise there's a failure to operate pay as you earn, and that would lead to interest and penalties on that basis. The other element is there are occasions where there are benefits provided which the employer would like covered by the pay as you earn settlement agreement, the PSA. For example, let's say you take people out for staff entertaining and the cost is more than £50 per head, or the average cost is more than £50 per head. And sorry, importantly, you take them out for entertainment, you don't want them landed with a tax bill on that basis. Well, if you don't want them landed with a tax bill, you need to agree to pay it on their behalf. So let's say I took people out and it's not part of the annual function, it's like £100 per head. I pay the food for the food and the drink. And then on top of that, on top of the £100 per head, I'm going to pay the tax on that amount of money. But of course, because I'm paying the tax is an additional benefit to the employee, and therefore it is grossed up for the tax, which nearly doubles the cost. So important to understand that although the PSA takes pay as you earn settlement agreement, takes away responsibility from the employee, and you would want to do that in an incentive, it does layer additional costs to the employer. I thought at this point, can we get the first poll? I'd like the poll on payrolling benefit. Oh yeah. How many people do you employ? So just if you could answer the question anonymously. Well, it is anonymous. If you answer that question, that would be great. Give you a couple of seconds to do so. Okay, let's see the results. Ooh, under 10, 10 to 50. Ooh, a couple of people with 1,000 to 5,000. No, a few, 5 people with that, but most either under 10 or the 10 to 50. Right, that's interesting to know. So the other element which has come up, and certainly those people who are at the higher end of the scale or are advising people at the higher end of the scale, we would look at country by country reporting. This has become important for 2 reasons. One is if you get involved in transfer pricing or reporting to HMRC on an international level, this reporting is either advisable or indeed mandatory. Or if you are saying you are not in, say your company has global tax revenues above 750 million euros, then this type of reporting becomes mandatory. And if you want to opt out, stay out of Pillar 2, which is the global minimum 15% corporation tax rate, then we are looking here at a requirement to fill in the CBCR, country by country reporting. This gives a snapshot to HMRC and other tax authorities if it's shared with them, which it often will be, of what their position would be. And they use algorithms and artificial intelligence to think, is there a disparity? Is there a disparity between the number of employees, the amount of money that is spent on them, and the share capital and accumulated earnings, and more importantly, the profits which are reported in that jurisdiction? So this, as you can see, can give them a snapshot of your revenues between connected parties, and the sort of elements that they're going to look at there is the sort of thing they're going to say is, actually there's a disparity. There are a lot of employees, there's a lot of tax that they should be paying, but they're not. And we may ask questions. Of course, looking at the income tax paid, normally on an annual basis, but this is something that you will need to think about in terms of your number of employees and the reporting on that basis. Filing deadlines for forms. Filing deadlines for the forms P11D is the 6th of July, following the end of the tax year to which they relate. For late submission of the forms, there's a further maximum initial penalty of £300 per document, plus a further £60 per document per day until the submission completed. HMRC must make an application to the first tier tax tribunal for the initial penalty to be imposed. If imposed, then HMRC can then charge the additional daily penalty. So I remember the days, puts me older than I'd like to think, when they were all done on paper. And you would send stacks of stuff up to the tax district where you'd get them done by courier so that you knew they'd been submitted. It's quite interesting the amount of times that we had to send these forms by courier to arrive by the 6th of July. And then there'd be somebody on the revenue desk at that point to receive them. Of course, now there are no submission by paper. It's all done online, which I suppose does make it easier from that point of view. But it's important also to understand it's not just something where you look at the paperwork of the P11D, filling it out. It's also all the foundations, the figure works, and everything else that is required in that respect. Just check there's nothing in the Q&A box at this point. No. So I then come on to, I talked about taxable expenses. What is the main principle? So if you are an employee, it is wholly necessary and exclusively in the performance of the duties of the employment. If you are self-employed, you take out the word necessarily and also in the performance of the duties of the employment. And I think it's worth thinking about the principle there. Wholly and exclusively, you sort of understand, although there are elements that you would say would be, when you look at that, there are elements that you would say would be the best way to say is the duality of purpose. So there are elements that are known as duality of purpose, and duality of purpose is something that you need to think about. In essence, most elements that are a lot of expenses are in duality of purpose, but some of them are still allowable. So subsistence, when you go on a business trip, arguably duality of purpose, you know, you have a personal need to have water and food, but it's allowed that if you're on a business trip, that you can have water and food and even reasonable amounts of alcohol. Half a bottle with a meal is allowed. And that, I think, is what is important on that basis. HMRC doesn't take as I say, it doesn't reduce it to the absurdity. Yeah. You could argue, well, there's no need for an office anymore. You could just go to your local public library or you could use a space in home. Is that necessary? But actually, what HMRC does is take a more pragmatic view than that and say, well, the normal sort of business expenses should be fine. And also, which I think is important, is that they put the onus on the employer. They take the view that employers will not generally reimburse or give unnecessary expenses. So it's generally the point HMRC would make is, well, the employers reasonably is exercising his or her judgment about what expenses they should reimburse. And at least up to a point, they will leave that up to the employer. When the employee is trying to get unreimbursed expenses, that is much more difficult because HMRC will turn around and say, well, if the employer didn't think it was necessary to reimburse, why should we give you a tax deduction? And noticeable from the 6th of April that working from home expenses, which are unreimbursed by the employer, the employee will generally not be able to claim as a deduction. HMRC has been sort of besieged by lots of employees claiming lots of deductions against tax for expenses that have not been undertaken by their employer. And therefore, on that basis, whether they're training expenses or other expenses, and HMRC will often say, well, if your employer hasn't thought it worthwhile it being reimbursed, why should we give you a tax deduction? And that's a real big issue on that basis. Okay. So when I look at wholly necessary and exclusively in the performance of the duty of the employment, of course, as I say, that is stricter than for the self-employed, because with the self-employed, it's wholly and exclusively, doesn't need to be necessarily, and it's not in the performance of the duty of the employment. The necessarily ties it back to the fact that this isn't an optional element, and the in the performance of the duty of the employment gives it a time factor on that basis. And I would contrast that to putting an employee in the position to perform the duty. So a classic example of putting you in the position to perform your duties is, of course, travel to your place of work, which is generally not allowable as a deduction unless it's potentially a temporary place of work, and that has very complicated rules. I take my example at the moment, which is I'm suffering a bit from a cold. So there you are. This is what I'm taking, the wholly exclusively and necessarily in the performance of the duty. So if I was an employee rather than self-employed, what could I take as a deduction? I think that the night nurse I definitely couldn't take because that's supposed to aid you sleep. The day nurse, if I'm taking the pills during the lecture in order to keep me going, possibly I could take them, just like the electricity to power this laptop. And I definitely think that the strepsils that I'm sucking to make sure that my voice doesn't run out, I think they should be allowed. And somebody said, well, what if you take some of the, so somebody said yesterday, so Jeremy, what if you take some of those when you're not lecturing? I said, aha, what you do there is you have your strepsils for your lecturing time and you have your strepsils for non-lecturing time. Anybody who has a different technical view on this, I'm very happy to entertain it. It's not a lot of money, but I think it makes the point. Let me look at residence and FIG. So residence and the foreign and income and gains regime. And these were the changes in April 2025. And well done to artificial intelligence. It managed to get me a picture of FIGs. So people at least might remember it from that point of view, standing for the new regime of foreign income and gains. So let's go back to the fact that domicile has at the moment been largely, not completely, I mean, you'll still find remnants, when they sort of do a spring clean of legislation, it always seems to take time. We left the European Union now, well, in terms of the nature of the European Union, in terms of the full transactions, the transitional arrangements, and so on. We actually left 6 years ago. January was it? December 2020, January 2021. So what we're looking at there is 5, 6 years ago, is when we left the European Union in terms of its transitional arrangements and its ability to impose rules on the UK. And there are still references to the European Economic Area in our tax legislation. Generally speaking, the interesting points are that a lot of the rules which required us to give equal treatment to the European Union or residents of the European Economic Area have disappeared, and tax reliefs are limited to UK residents and UK businesses, or the businesses which have UK interests. And they've taken away a lot of the non-discrimination clauses which allow residents from the EEA to claim different reliefs. The one relief that they can still generally claim is the personal allowance. But it's interesting. It took a number of years. So creative reliefs used to be able to get for expenditure all over the EEA. Now you can only get it for you if the expenditure is used and consumed in the UK. And the same is true with overseas tax losses being repatriated following the Marks and Spencer's case, where they reversed that when we left the European Union, and a number of other things that they did. So domicile, there'll still be bits and pieces of domicile sitting around, I think, for a while, as well as historic positions and historic cases. But generally, HMRC has moved to the statutory sort of residence test. In terms of the determination, you look at residence. So just a reminder, you start off with the automatic non-residence test, or almost satisfying the automatic overseas test. The answer to that, if you satisfy that, then you are automatically non-UK residents. You don't need to go any further. And the interesting element is that you could own a house in the UK and still satisfy the automatic overseas test, and be not UK resident. And the ordering, the sequencing of the tests allows that to happen. If you are not automatically overseas, then do you satisfy the automatic residence test? If the answer to that is yes, then you are UK resident. If the answer is no, does the individual satisfy the sufficient ties test? That is the tiebreaker test. If you have enough connections to the UK and spend enough days, then you would be UK resident. But if you're not UK resident. So important to understand that, because residence has become important in terms of employers. Are they required to deduct pay as you earn? Are the employees, even if not resident, performing substantial duties in the UK? Are they potentially dual resident? And indeed, more than that, could they have a split role? Could they have a split role? And if they have a split role, do you end up with payroll or reporting requirements and withholding requirements in two destinations? So let's say I have somebody, he's a German, and he comes to the UK 4 days a week to work for a UK asset management company. And day 5, he goes back to Bavaria, to his Schloss in Bavaria, where his family live, and he works 1 day from his Schloss in Bavaria. The argument might well be that he might not be resident in the UK, or he might be dual resident. He's certainly probably under almost certainly under German domestic rules, he would be resident in Germany. So on that basis, probably 4/5 of his income would be reportable in the UK payroll and 1/5 in the German payroll on that basis. And that would lead to all sorts of questions. But of course, in terms of the FIG regime, if you've been not resident in the UK for a period of 10 years, so let's say you went to Dubai in 2010 when they introduced the 50% rate of tax, which was then reduced to 45%, and suddenly you come back to the UK. I'm not quite sure why, current events and so on. Potentially, even if you are a Brit, you can benefit from the foreign income and gains regime. In other words, that the overseas income would be exempted for up to 4 years from UK tax. And then potentially, if you've had a period of 10 years non resident in the UK, up to 10 years from IHT. That's the only thing I mentioned on IHT because this is employment course. Let's look at the automatic overseas test. Not residents in the UK for the whole of the 3 years prior to the current one, and in the UK, less than 46 days in the current tax year. I think that's set very well because it means that you can watch every test match and the one-day internationals. And if you don't spend any other days in the UK, you could remain non-UK resident. Or I suspect it was looked at for quite high net worth individuals living in the Thames Valley who want to watch their horses race during the flat season. They can do so without becoming residents in the UK. However, the UK is a bit like Hotel California, difficult entry, relatively easy to enter, but difficult to leave. Because if you're leaving individual residents in the UK in one or more of the last 3 years and less than 16 days in the current year, then, as I say, if you're a leaver, if you have a track record of residence in the UK, then the figure for automatic non-residents drops to 16 days. They want to make it more difficult for the people based in the UK to leave if they're not making a proper break. And then the element for employers, which I think is important, is for individual leaves the UK for full-time employment abroad. Question: what is full-time employment? For greater than one tax year and is in the UK for less than 91 days in the relevant year. And why do I think that is important? I think that that is important because a lot of people think, 91 days, that gives me a big potential benefit on that basis. And you think to yourself, yes, but it needs to be full-time employment. And I've had people tracking for like 87 days. And I'm thinking, you're not leaving yourself a great deal of time should you be unexpectedly required to be in the UK. And then, of which less than 21 days worth of work, working days greater than 3 hours. I always think that that's quite interesting on that basis. What I think about on that basis, actually, I think there's a typo there. I'm pretty certain that is 31 days, not 21. Sorry. So 31 days on that basis. To do, if you're using the PDF, scrub that out. That's 31 days worth of work. The interesting element gives you a bit more time. The interesting element with the 31 days there is HMRC's definition of a working day is sort of greater than 3 hours, which has an interesting view about what a working day should be on that basis. But interesting enough, that 3 hours also includes training, reporting duties, and business travel. If you are concerned as an employee whether you can operate FIG or the overseas workday relief, one of the important issues about that, I think, is there needs to be a bit of employment tracking on that basis. Any questions? Right. So we haven't had any. Automatic residence test. So if you fail the automatic non-residence test, then you look at the automatic residence test. on that basis. The automatic residence test is a day count. So, are you in the UK for at least 183 days in any tax year? Well, you wouldn't have satisfied the non residence test if that was the case. And based on presence of midnight, but does not include transit days or exceptional circumstances. And exceptional circumstances are quite narrowly drawn. And actually, I think people are quite interested whether fleeing war in the Middle East is counted as an exceptional circumstance. I suspect it would be. And interestingly enough, I recall it, although I wasn't practicing at the time, that 47 years ago, HMRC gave a special extra statutory concession for people fleeing the Iranian Revolution. I am not sure whether they're going to do the same thing this time, partly because extra statutory concessions are not something they do. But it will be interesting to see because there are some people in Parliament who I think don't want to do that. The second element, which is not necessarily inconsistent with automatic non-residences, I'd say, but if you fail the automatic non-residence test because you've spent too many days in the UK, you then look at a question of the home in the UK. Individual has only a home in the UK, or if greater than one home, all are in the UK, must be available for use for 91 days in the year, does not include holiday homes, weekend homes on basis. And that's, of course, quite an interesting element in terms of the looking at, sort of the extra council tax for second homes and all that sort of stuff. Automatic residence test continued. What we're looking at there is full-time work in the UK, full-time work in the UK for 276 days on that basis. 75% of days in the tax year must be working days in the UK, including travelling time and for business journey. Full-time is an average of 35 hours a week. Significant break greater than 31 days, not on sick leave, annual leave. So you do need to look where you have unpaid leave or exceptional leave, whether it counts in there. The default on that basis is UK tax residency by the sufficient UK ties test. Let's have a look. If you look at sufficient UK ties, so this is the tiebreaker third test, if you were in the UK, didn't have a track record of 3 years in the UK, then you're allowed up to 45 days in the UK, as I say. So somebody who's foreign, who just comes to the UK to watch the test matches and do some shopping in between, particularly when the test matches end in 3 days, on that basis, they could spend up to 45 days in the UK. Automatically non-resident, you don't have to look at the factors. Then, if, for example, they have fore or war connecting factors, then 46 days will take them into UK residence. 91 to 120 days, 3 factors. 121 to 182 days, 2 factors. And obviously, if you spend more than 183 days in the UK during the tax year, you're always going to be resident here. Doesn't mean you can't be resident somewhere else. The test for leavers, where you've got a record in the UK, what we're looking at is less than 16 days. You'll still be automatically non-resident. So if I leave for somewhere and I remain outside the UK for all but 15 days, I'm okay. If, however, I spend longer in the UK, then I have to look at my different factors. And as you can see, the thresholds are different from the arrivers. But once you've spent 183 days, you'll always be resident in the UK. If we look at the factors, what we're looking at is the ties are family ties, accommodation, work, 90-day tie. You've had 90 days within the previous 2 years. In the UK, in either of the tax years, that would be a tie. And funnily enough, it makes it quite difficult if you regularly spend 90 days or more in the UK to avoid UK residents. And it's quite interesting because although they abolished the concept of ordinary residents 13 years ago, effectively, one of the things I say to clients is, well, have a look at the 90 days because that affects not only the full-time working in the UK element, but it also is one of the ties. And it is actually quite difficult if you regularly spend 90 days in the UK to avoid UK residents. The rules, as I said, for non-UK domiciled individuals were changed and now made residence rules. Can we look at the second poll? See if people are still there. So the second question is, do you payroll benefits? Remember, they were going to make that compulsory. I'm sure they will do. So, payrolling benefits. The opportunity to get your benefits in kind wrong 12 times a year rather than just once. Can we see the answer to that, please? Ooh, 2/3 still don't. You will need to think about it, putting benefits through payroll, because although at some point this will become compulsory. Originally, they were looking at April 2026. I think they have postponed it, but it's an element which is coming in. And it would be interesting, as I say, I think payrolling benefits is one of those areas which is an additional burden on employers, but means that it is less likely that the employees will be faced with a nasty tax bill where they do their self-assessment return based on their benefits position. Okay, thank you for that. So let's look at non-UK domiciled individuals, non-UK resident individuals, and the FIG regime. So domicile changes, abolition effectively the non-domicile regime from 6th of April 2025, temporary repatriation facility. So if you've got income that was subject or escaped UK tax because it wasn't remitted, remember if it relates to pre-6th of April 2025 income, you remit it, you will pay subject to UK tax on it. But what they've done is they've given people a temporary remittance facility so that they can bring in that money that has escaped UK tax that would have been taxed if remitted to the UK, and you pay the bargain basement rate of 12% for 25, 26, and 26, 27. And then for 27, 28, if you bring the money in, it would be at 15%. There's no 50% relief for non-DOMs, which was planned by the previous government to encourage people to stay. And probably the area that was most controversial, in my view, probably cost the government quite a lot of money in terms of people leaving the country, was the removal of an excluded property trust. Excluded property trust, what it would do would mean that you came to the UK, if you put your overseas assets, your house in Sydney, your pied-à-terre in Dubai, into the excluded property trust, even if you became subsequently domiciled in the UK, there would be no IHT on those overseas assets. The government, in its infinite wisdom, changed this rule. And a lot of people said, well, I'm okay about paying IHT on UK property, but I'll be blown if I pay IHT on non-UK property. So that's one of those sort of relatively big issues that came up. But I'll say no more because this is employment taxes. However, and then there's also CGT rebasing date for non-DOMs in terms of the base for the acquisition cost or the base cost that you would put in against the proceeds for overseas assets is 5th of April 2017. Overseas workday relief, which is important for employers, works for the first 4 years of residence. The beautiful thing about it, which is undoubtedly better than the previous regime, is that we're no longer bothered about the remittance basis of taxation. So, why is that important? Well, not being bothered by the remittance basis of taxation means, of course, that you end up take all the money in. You just have to look at whether you've got overseas workday relief on that basis. The relief is capped at the small of £300,000 or 30% of net qualifying employment income. So you get a full exemption for foreign income that is not employment income, but you get a overseas workday relief, which is capped, very similar to what the Dutch system was, at around £300,000 or 30% of net employment income. So let's take an example here. Armand becomes a UK resident on in 25-26 and is eligible to make an election for OWR in that year, but chooses not to do so for reasons that would not be totally clear, apart from to use for this illustrative example. He remains UK resident for 26-27 and makes an OWR election in his return. Armand had received earnings of 1.2 million in 26-27, which are for the duties he performed in that tax year. He also received a bonus of £200,000 in 26-27, which related to his duties performed in the 25-26 tax year. His taxable earnings in 26-27 are 1.4 million. £480,000 of his Armand's 1.2 million earnings for 26-27 relate to duties performed outside of the UK. So this is the maximum amount of relief he could claim, subject to the financial limit. The interesting element, and this is why you need to think about whether to make an OWR election or not, is no relief can be claimed in respect of the £200,000 for 25-26, as he failed to make an OWR election. While Armand has taxable earnings of 1.4 million in 26-27. The financial limit only considers the relevant employment income in that year, which is earnings of £1.2 million. The financial limit is the low of £300,000 or £360,000, 30% of 1.2 million. Therefore, Armand can claim relief of £300,000 under OWR in his 26-27 return. And you can see that that could be important for employers in terms of what they put through their payroll. The foreign income and gains regime is quite complex, and an ex-colleague of mine, technically very good, Steve Wade, one of the top people in this area, did quite a long article in Tax Journal talking about some of the complexities of this regime. Whilst generally welcoming, it said it's a bit more complex than it needs to be. And, you know, there are three separate reliefs, a claim for relief on foreign income, a claim for which could be in its entirety, a claim that we've just looked at for relief on foreign employment income, overseas workday relief, and a claim for relief on foreign gains. The other element that you need to think about here is what is your first year for qualification? And what we're looking at in terms of the first year for qualification is, you know, the individual is UK resident for the tax year. The individual is not disqualified for the tax year. The tax year is the first tax year the individual has been UK resident after a continuous non-UK resident period of 10 years. So again, not based on domicile, not based on nationality. It's whether you've had a period of 10 years non-resident. A disqualified person is somebody who's a member of the House of Lords or the House of Commons for the year. Interesting, I think the hereditary peers leave the House of Lords at the end of this session, but if the end of the session comes before the end of the tax year, they would still be a disqualified individual on that basis for the following year. But of course, I suspect most of the hereditary peers are actually residents in the UK. I did meet or have there was discussion with a hereditary peer who'd left the House of Lords on the basis he was still allowed to be there, on the basis that otherwise he would have to make huge declarations of interest, and he decided it wasn't worthwhile. After the first year, the individual is UK resident for the tax year. The individual is not disqualified, same definition as for the tax year. And the tax year is one of the next 3 tax years after the qualifying tax year, or year that would have been qualifying if the individual had not been disqualified. So what are the practical issues with the 4-year tax access period? The maximum period that the new regime can apply for is 4 years. However, it's likely that most individuals will not be able to benefit from that entire period. Most countries have a calendar tax year, unless an individual has the luxury of being able to plan precisely when they come to the UK. It is unlikely they will be able to arrive at the very start of the UK tax year. It is more likely that their first tax year will be a split year. It should also be noted that UK domestic legislation is taken into account when considering both the 10-year continuous non-UK resident period and the first 4 years. So it means that if a person is dual resident with the treaty attributing residence to the other jurisdiction that year, that would still qualify for the purpose of the test as UK resident. For this test, we just look at the UK domestic rules. This could mean that the individual does not qualify at all for the special regime in a particular year, or that they do not benefit from the regime in the years where they are dual resident, as the treaty would shelter the foreign income and gains. Anyway, take an example, non-residents. Felicity is solely UK resident in 25-26. In the previous 10 years, she was either not UK resident or UK and German resident, with Germany being the resident state under the UK-Germany treaty. Felicity therefore would not be eligible for the new FIG regime, as under UK domestic law, she has not been non-UK resident for a period of 10 years prior to 25-26. Because what's happened is, even if she's non-UK resident under the treaty, she wasn't non-UK resident for that full 10 years under the UK domestic law. Remember, if you can spend as little as 16 days to be resident in the UK, that leaves a lot of time to be resident somewhere else as well. And dual residence on that basis would be looked at from the treaty point of view. But in terms of that as well, you could be resident in Germany under the treaty, still resident in the UK domestically, and that could affect your FIG entitlement. Intermittent residents, I'm just going to finish those before you get a well-earned coffee break. Kirsty's UK resident on that basis, having come to the UK for work purposes. She has never before been resident in the UK. A work project means she must return to Germany in May 2026 and is not UK resident for 26-27 and 27-28, resuming UK residence in 28-29, and remaining UK resident for the next 5 tax years. Since only the first year of UK residence after the 10-year period of non-UK residence and the 3 following tax years can qualify for the regime, it means that Kirsty can really only make the claims for 25-26 and 28-29. The opportunities in 26-27 and 27-28 are wasted on that basis. A bit of tax planning about that point. But as I say, the importance of thing is that people need to keep track of their residents, and probably employers with the day count on employees who move about on assignment. The use of qualifying new resident rules in section 377 also limits the period for the travel and home leave exemption, i.e. travelling back to your original country, potentially including home leave, not just for you, but for your spouse, civil partner, and children under the age of 18. That is now limited to 4 years, where it used to be 5. Okay. At this point, let's take a 10-minute break. So the question from Romas is, where an individual is both UK resident and tax residents in another country, is it correct that we should first refer to the relevant double tax treaty to determine whether income and gains are taxable before applying UK tax domestic rules? My understanding is that international tax treaties generally take precedence over local tax legislation, but I appreciate your confirmation on the correct approach. Actually, it is, although conceptually this is quite difficult, because although international tax treaties take precedence over domestic rules, they only do so to the extent that they reduce taxation. So you start off by saying, what is the domestic position? Because if the domestic position is there's an exemption, end of story. You don't need to look at international tax. So if you're looking at, say, tax withholding on dividends, the UK doesn't impose it. Whereas under the treaty, it says the UK may impose a withholding of dividends at 5 or 10%. So you always look at domestic law first. And the reason you look at domestic law is because under domestic law, if there's no tax liability, there's no tax liability. You calculate what the tax liability is under domestic law. And then if the treaty reduces the liability, you then look at the treaty on that basis. If the treaty says you may impose it, but you decide not to, the treaty does not impose a liability that does not exist already in domestic law. All it can do is either recognize your right to tax it or potentially reduce the tax to a prescribed lower level, particularly in terms of withholding taxes. I hope that makes sense. Can you all hear me? Actually, you don't all need to answer, but if somebody can say they can hear me, that would be great. Good. Okay. Great. Fine. Seem to be heard. Hope that answered the question. But thank you for the question. It's a good one. Look at domestic first, then you look at the treaty to see how it may affect it. And the treaty can only reduce your liability, not increase it. So let's look at trust protections very briefly. And the issue is that it was a fairly standard element in terms of trusts that you would get relief if you kept assets in a trust that you put in before you became UK domiciled. That doesn't work anymore, but you do get protections in the FIG regimes for the first 4 years in terms of trust, and also the transfer of assets abroad anti-avoidance legislation. And once you're beyond that period, 4 years, you're taxable on the full amount in the trusts in terms of gains, and after 10 years, IHT as well. I'm going to move on to status, so secondment versus employment changes. Before I do, let's have the third opinion poll, please. We have the third poll. Okay, what's the answer to that? No. Oh, so it's a smallish minority. But do watch for people who are sort of mobile employees who go overseas for considerable periods of time, or work from home and their home is abroad. That can cause you a number of issues, both in terms of corporate tax and in terms of employment taxes as well. Thank you very much. So, secondment or new employment, one of the elements you think about is if I get new employment abroad, what I end up with is the existing employment is terminated. I'm on the conditions in the host country, and there is host country control on all terms of employment. And the share schemes would be also then in the host country. With secondment, the existing employment remains. So if I second you to France or to Germany or to the United States or somewhere else, the existing employment remains. It's based on home country terms. The home country retains hiring and firing, and the share schemes would be in the home country. So, big difference, and it's important to coordinate between payroll, HR, and the tax department about what your policies are on secondments abroad. In terms of tax, if you change employment, then there's probably no possibility of treaty relief under Article 15. The national insurance would be in the host country on the default basis. All remuneration would be related and charged on the host country. And there would be no opportunity for detached duty relief that I'll talk about. With a secondment, treaty in the host country is available, potential coverage and liability in the home country, some carve out to home country, in terms of if you've still got residual duties in the home country that you were seconded from, there may be tax liabilities there. And splitting pay between two countries may be interesting in terms of the maximum use of personal allowances and lower rate tax bands. And detached duty relief may be available for a secondment, temporary secondment abroad. In terms of the employment position, if there is an employment change, generally speaking, you would be on localized terms, localized employment law, local social security, and double tax treaty relief, as I say, is unlikely under Article 15. If you are seconded abroad, then we're looking at expat terms. Home employment law will still be relevant. And of course, the UK employment law is likely to change with the passage of this Employment Rights Act, which has some consequences, creating some fear and trepidation within employing within employers. Home social security, generally the UK has a low social security cost, even with the recent increases in employer NIC, than most of Europe, so quite useful to stay within home social security. And double tax agreements are more likely to give you a carve out, either a full carve out under Article 15 or part 15 to or a partial carve out under 15.1 from potentially host country income tax if you spend less than 183 days in the host country. So if I go to France for 2 to 3 months, potentially that income would be not liable to French tax, but would remain liable to UK tax. I talked about detached duty relief. That's one of the biggie reliefs that's still available. So where an individual is seconded there to a temporary workplace, normally for a period not exceeding 24 months, they can obtain detached duty relief. This covers costs such as accommodation, subsistence, travel, and utilities. If you consider that, let's say, the costs are 50,000 a year, and that sounds a bit on the low side, 50,000 a year grossed up is almost another 50,000 in tax and national insurance, depending on the marginal rate of the employee. So over 2 years, the modest figure of 50,000 travel and subsistence could end up in, if you get detached duty relief, costing the employer another 100,000. If, however, it is if you get detached duty relief, the employer saves £100,000 in costs over that 2-year period. So detached duty relief, if you can stay within it, is extremely useful. Moreover, detached duty relief is not just for international secondments. If you second somebody to the Lake District for up to 2 years, that would work for that as well. What sort of challenges are there? Well, intention to remain less than 24 months. HMRC obviously looks at this relief. I think when they gave it, I don't think they realized quite how valuable it would be. So, does it really say in your documents you're going to stay less than 24 months, or do you have secondment terms, which means that your intention was to stay more than 24 months? The scope of the costs that are being included in travel, subsistence, and accommodation, and the size of the accommodation. And this was challenged successfully by HMRC in the Tim Healy case. In the Tim Healy case, this was an actor who moved from Manchester to London and needed a bigger accommodation to entertain his friends. And what the court said, well, this is not detached duty relief in terms of the accommodation, because you're getting much bigger accommodation than you would actually necessarily need for yourself. Obviously, in terms of your intention to stay in the UK, if it's less than 24 months, potential detached duty relief. If it's permanent, you do not only need to look at detached duty relief, but if it's a historic case and somebody said, oh, I intend to be in the UK permanently, you might want to look at their claims in terms of domicile in the past up to 5th of April 2025. Any questions at this point? If there are no questions. No. Can we have the next poll, please? This is the Employment Rights Act. Passage of it is just, I think, about passing Parliament now. Major issue is that the probation period where you can terminate employment without issues was going to be day one rights. Now I think you've got 6-month rights. So there was some sort of compromise on that basis. But there are a lot of other issues which have come up. So I'd be interested in your opinion on whether the Employment Rights Act means that you're going to end up taking on staff, reducing headcount, or freezing headcount. Okay, interesting. So freezing headcount is the most interesting, 65%. Reducing and taking on staff are very similar to each other, and it's clearly had an effect on unemployment, particularly youth unemployment. Why would you want to take on someone inexperienced and not be able to manage them out without all sorts of issues? So there has been an effect on employment already, chilling effect on employment. And it will be interesting to see how this works on. But it's fair to say that actually it's, well, 20% of you saying that you're about reducing headcount, which is more encouraging in terms of that than some other surveys I've seen. Okay, thank you for that one. Current landscape and senior accounting officers. So there is a requirement that if your company is above 200 million, that we are looking at the employment tax complexity. And the requirement to have a senior accounting officer doesn't say the senior accounting officer doesn't say that all my tax returns are absolutely 100% accurate. What they're saying is that they have the systems and the staff to deal with whatever complexities there are within my reporting requirements. This is an internal requirement. So somebody, normally the finance director, has to do this. So what am I looking at? Well, what are the difficulties in terms of employment tax? So complex remuneration arrangements that people have. Employment taxes function devolved around a business, meaning less coordination there and less control. Increased popularity of outsourced services. Remember that you can outsource functions, but you can't outsource responsibilities. And I think that that's quite important on that basis. Proliferation of internationally mobile workforces, particularly post-COVID, and that can create local issues as well. Insufficient importance attached to employment taxes by the business. Employment taxes tend to be seen because as not as important as corporate taxes, although that has changed over the last decade or so. But sometimes employment taxes are rather considered as an afterthought. Well, it's employees, it's their taxes, rather than considering the effect on businesses. Managing global policies in diverse legislative environments, and for sure, despite emerging blocks like the European Union, there are considerable differences at member state level. And of course, now the UK outside the EU can and does diverge from European Union norms. Numerous ad hoc and one-off events, which could be global elements, so war in the Middle East, meaning that people are moving elsewhere. Multiple systems feeding into each return, whether it's benefits or share schemes or payroll or expenses, and possibly no clear assignment of roles and responsibilities. Who's actually overlooking this area? Who is the UK risk? Who is the UK risk person overlooking and understanding what is going on in each area? And the interesting element in terms of SAO is the sort of questions that people will have. Sorry. We have an active engagement and clear understanding of certification. We have an active engagement but have not discussed certification. We have active engagement but employment tax issues have not been discussed. We have occasional discussions on issues as they arise. We have tried to engage on HMRC on employment taxes without success. We've not engaged HMRC beyond requesting me to. So you do need to think about, you would want to fall into number one on that basis. And you would need to think about, do you have a proactive relationship where you raise issues and try and deal with things before they become a problem? Or do you end up with a real problem on that basis? To what extent have you been involved in the SAO process? So, actively involved, reporting on a regular basis, with control over employment tax issues, involved, taking part in workshops and put together process maps, limited involvement, have been involved in basic discussions, no involvement, not been consulted so far, or does not apply. Let's look at a bit of the detail on this. The main duty of the senior accounting officer or of a qualifying company must take reasonable steps. Excuse me, a level of subjectivity on that. Reasonable steps to ensure the company establishes and maintains appropriate tax accounting arrangements. The senior accounting officer of a qualifying company must, in particular, take reasonable steps to monitor the accounting arrangements of the company and to identify any respects in which those arrangements are not appropriate tax accounting arrangements. What is the certificate for commissioners? The certificate must state whether the company had appropriate tax accounting arrangements throughout the financial year. If it did not, give an explanation of the respects in which the accounting arrangements of the company were not appropriate tax accounting arrangements. So you can qualify it, but the certificate needs to be reasonable. And in terms of it, it's about, do you have the systems? Do you have the staff in order to get it right? Now, HMRC recognise that you're not going to get it right all the time. You are human beings on that basis, and everybody makes mistakes. Some people don't own up to them, but I think the condition of being a human being, philosophical question for Friday morning, is that we do make mistakes and hopefully we learn from them. But what they're talking about is, even if you do make mistakes, that isn't so much the issue, but is it a systemic mistake? Is it a mistake because you haven't got the right sort of staff? Or is it just a one-off or human error? Finance Act 2009 imposed an obligation on senior accounting officers of large companies to ensure that appropriate tax accounting arrangements have been established and maintained, and provide a certificate to HMRC for each financial year of the company, stating whether the company has appropriate tax accounting arrangements, or where it does not, provide an explanation. Where does it apply? So it applies to UK registered companies that in the preceding financial year had turnover of more than 200 million or gross assets of more than 2 billion, aggregated with other companies in the group. So you can't fragment into different companies and avoid the liability on that basis. You've got to look at the group and are you at 200 million? It applies to financial years beginning on or after the 21st of July 2009. Penalties of £5,000 apply where the company fails to notify HMRC of the name of the SAO. The senior accounting officer fails to comply with their main duty to take reasonable steps to ensure that the company establishes and maintains appropriate tax accounting arrangements. And the SAO fails to provide a certificate to HMRC, or provide a certificate that contains a careless or deliberate inaccuracy. Now, there is a case about Mr. Thatcher, who successfully appealed an SAO penalty on the basis that he'd asked the board to do things when he took over. He kept on asking the board for more resources, and eventually the board, there were improvements even if it wasn't at fully the right level of compliance. But he'd shown he'd done his best. You could minute the changes where he was looking for extra resources, and he did get some, and there were some improvements. So again, you don't need perfection, but you got to show you're trying. Any questions at that point? Well, if no questions, I can't see any on Q&A. Let's go for the next opinion poll. So, do you run any of the following share schemes: share incentive plan, share save or SAYE, CSOP company share option plan, or the EMI, the enterprise management incentive? Give everyone a minute to answer. I'll get another tissue. Okay, let's see the answers. Ooh, as one might expect, EMI is the most popular. And I suspect because most of you are advising smaller companies, ShareSafe, which is very popular with big companies, is less popular with smaller and medium-sized outfits, particularly because of the low rate of uh, um, interest. Although, as well, one saw from yesterday, interest rates may go up. EMI, so the changes may be of interest to people, and a few people encouragingly doing the SIP plan, the SIP. Thank you very much. We'll come on to that a bit later because there's some interesting changes to EMI schemes. So, employment tax update. Administrative issues, so updating of bulk data gathering powers, so powers to get information from third parties, whether it's banks, build, building societies, travel agents, estate agents, and third-party providers, so and credit cards in particular. More MTD regulations published. So remember that making tax digital or making tax difficult, all starting on the 6th of April. Joy unconfined, I'm sure. Mandatory tax advisor registration, measures relating to the promoters of tax avoidance schemes, I won't go into that, and draft measures relating to tax advisor facilitated non-compliance. All of those, HMRC is getting extra powers. It's an interesting one in terms of a type of planning that was very popular is now a lot less popular. We're talking about remuneration trust contributions, Marlborough DP Limited versus HMRC. Marlborough DP Limited was a dental practice wholly owned by Dr. Thomas. Under a marketed tax avoidance scheme, contributions were made by the company to a remuneration trust that in turn loaned the funds to Dr. Thomas. The company believed that the scheme meant that profits could be extracted from the company without a tax liability, and contributions to the trust were deductible for CT purposes. HMRC disagreed and sought to collect both income tax and national insurance contributions on the earnings and disallowed the deductions. The initial appeals on this basis, perhaps unsurprisingly, the FTT found in the company's favour. The loans were more like a dividend paid to a shareholder. Perhaps that was surprising. The upper tier, which is the next level up, overturned the decision Part 7A, the contributions were connected with employment. No deduction for corporation tax as the sums were not paid. Wholly and exclusively for the purposes of the company's trade. Here was a tax avoidance purpose. So the company appealed to the Court of Appeal. So remember, there are four courts that you can look at, four tribunals. The first tier, where matters of facts are decided. You're only supposed to appeal to the upper tier on a point of law, although sometimes HMRC and others try to get it on the basis that people have misdirected things. The third court is the court in England and Wales. It's the Court of Appeal. In Scotland, it's called the Court of Sessions. And then if you get far enough, you can get to the Supreme Court of the United Kingdom. That superseded the House of Lords about 20 years ago. There was no test within Section 554 that required a causal link between the employment and the loan. If Parliament had intended to create such a test, it would have contained words such as from employment or by reason of employment rather than in connection with that was actually used. The upper tier was correct to conclude the arrangement fell within the general disguised remuneration legislation, which forces, where you get a deferral in certain circumstances, forces there to be a connection and therefore taxable in employment law, and also normally accelerates the tax charge to the beginning of the period. Although tax was employment income, no deduction was available for the contributions. So you get the worst of all worlds. If I pay salary from a company, that would normally be deductible for CT purposes. But the courts decided to really be quite harsh, because not only was it seen as employment, but it was also not deductible for CT purposes. So effectively, the contributions came out of post-CT income. So you're paying 19 or 25% on that. And then, to add insult to injury, there was employment tax and national insurance due on that basis, which of course means that this was worse than if they just initially paid salary. And I think that is actually quite important to understand. That if you go in for aggressive tax avoidance, you could, and this is the intention of both HMRC and the courts, notwithstanding the fees that you've paid, end up in a worse tax position than if you just conventionally paid elements to people. Disguised remuneration, so exercising the 7A power. So this is Stephen White, Gary Laws and others. IT consultants providing services to UK businesses via disguised remuneration schemes. Employed by an offshore company from which they received a small salary, probably covering their personal allowance. Balance of income paid to EBT, then lent money to contractors. Decision in previous cases found that such amounts were taxable employment earnings. Section 689 ITPA 2003 deals with the pay-you aspects when the paying entities offshores cannot be obligated to operate pay-as-you-earn. End user of services can be liable for pay-as-you-earn as if they were an employee. However, legislation known as the 7A power, where the HMRC would not collect if it was unnecessary or not appropriate for the end user to pay the tax due. In that case, the contractors then became personally liable for the tax. HMRC invoked this power. Two contractors applied for permission to seek judicial review, citing that HMRC should have taken account of their personal circumstances. Judicial review is basically where you say, not a question of tax law, it's a question of, is the process fair? Are HMRC exceeding their powers? This is incredibly complex and difficult to win on, generally speaking. The decision was that the permission to apply for judicial review was rejected. HMRC were not obliged to look at consultants' personal circumstances to see whether they could afford to settle the tax bill. Pay-as-you-earn regulations did not apply to scheme providers, as they clearly did not have a UK trading presence. The subsequent decision made by HMRC was within their remit, so you could not challenge. So if you end up with a personal liability, HMRC does not have to, before slapping on the personal liability, work out whether you can pay it or not. George Mantides. So he's a urologist. And this was a fascinating case because he worked at two hospitals, one in Medway in Kent, the other one was the Royal Berkshire in Reading. So in this case, there was the question of his status, and the difference was in one hospital he had more autonomy than in the other. So in one hospital he fell within IR35, and in the other hospital he didn't. The FTT found that outside IR35, and HMRC appealed too late to challenge this. The other one was. The company appealed against the second decision. Part of the problem in the second case was that assumptions had to be made about the hypothetical contract due to lack of information. There was a long delay in hearing this case because they were waiting for the decision in terms of the professional referees, which eventually found in HMRC favour. Once again, they considered the principles in the ready mix concrete case, which goes back to 1968. And this is an interesting element where we haven't had many or significant changes in law since then. What they're looking at is a case that goes back the best part of 60 years as the relevant case to look at in terms of employment. Found that control and mutuality of obligation existed, and no factors which were inconsistent with employment, so it was caught by IR35. It was a question of substitutes, use of equipment, the mutual obligation between the George Mantides and that particular hospital. So it's an interesting element there because in this example, the consultant urologist was seen as within IR35 in one hospital and performing the same duties or similar duties, but under different conditions in another hospital, was not seen as being within IR35. The important takeaway from that basis is that you can't read across all your different engagements and say, well, because I'm self-employed in this engagement, I'm self-employed in another. And I think that that is all key, that you do need to consider the facts and circumstances of each engagement. Here is something that I think is less surprising. Taxable income under failed DOTAS scheme, Brian Lynch versus HMRC. Brian Lynch participated in Caledonian, which is a marketed tax avoidance scheme that had been disclosed under DOTAS. At this point, most people should say, give up, abandon all hope who enter here. DOTAS, where you put it on your tax return, you put a DOTAS number on your return. It tells HMRC to inquire into you. So even if you win on the scheme, the amount you'll have spent on advisory schemes will probably be more than the tax saving. And of course, you end up with the pleasure of spending quality time either answering correspondence or in meetings with HMRC. Now, there are some very nice inspectors that I know, but frankly, time is money, and you do need to think about this before you do complex tax avoidance schemes. As with many of these schemes, a complex series of steps resulted in interest relief being available on money borrowed to buy into the scheme, offsetting income received. Scheme defeated a series of preordained artificial steps. HMRC sought to deny interest relief. Brian Lynch argued that if intermediate states should be ignored and the interest deduction disallowed, then interest income should also be ignored, as there was no overall economic advantage. Also, the second aspect involving the high income child benefit charge, where you claw back the child benefit, which was argued to be in breach of Brian Lynch's human right to a family life. Perhaps more of the unsurprising elements, this failed at the tribunal. The FTT found that just because the steps were found to lack commerciality did not mean that all of the consequences could be ignored. Each consequence had to be considered by looking at statutory provisions related to that aspect. Supreme Court has ruled in other cases that individual transactions have to be considered in this way. Interest was disallowed due to transactions having no allowable purpose. No actual income arose, but had to establish if any received, which legislation treated as having been received. This was deemed income being the discount on the loan notes. These could not be ignored, and so income remained taxable. Unsurprisingly, the argument regarding human rights and HICBC was also dismissed, and therefore the appeal was lost. Disallowed expenses claims. This is not about my strepsils, which I feel I need to take another shortly, probably at the next coffee break, in order to keep this going. Like you need electricity for a presentation. Disallowed expenses claims. Dennis Lucas versus HMRC. Courier driver for UPS was told that Apostle Accounting Limited had got tax rebates for colleagues relating to travel and subsistence claims. Why do you think they're called Apostle Accounting? Well, something at the A end, so you're hoping that people search for you a bit earlier, not because they are any good. I have no idea whether they're any good or not, but they didn't do Dennis Lewis a great deal of good. Dennis Lewis contacted the firm and asked them to do the same for him. This is always the problem with sort of golf club advice. He was registered for self-assessment. Company confirmed sums to be claimed and submitted tax returns, although he did not provide any details, or was he asked to provide receipts. At this point, you start getting a bit suspicious. HMRC opened up an investigation which led to discovery assessments on the basis of careless or deliberate behaviour. Dennis Lewis argued he had not approved the returns, but the company was his agent, and he'd authorised the company to submit claims on his behalf. And whilst the FTT had sympathy that he'd been caught up in what was a scam, the discovery assessments were valid and the appeal was dismissed. So, and I feel sorry for people, at least up to a point, who are really taken in by these scams. You see them, you know that there's a problem when you see on sort of the lamppost leading up where you're queuing for the Hanger Lane gyratory, and you see on lampposts, got a P60, we can get you a tax rebate. I mean, at this point, you do start to think, I've got a bridge to sell you. Yeah. And to be fair to HMRC, they are doing public information campaigns to try and deter people from going into these types of schemes. Here's another case. Football pundits' work fell within IR35. This is Phil Thompson. And generally speaking, on presentations, presenters, I should say, are losing their cases. It'd been lost by the company, was within IR35 at the FTT. The company argued that the FTT had made errors in laws because they appealed to the upper tier, and you can only do that in terms of errors in law. And that was in terms of the interpretation of the contracts between the parties, identifying the terms of the hypothetical contract, finding that a framework of control exists, not considering whether the third test from the RMC, the ready mixed concrete case, had been met. And I think that there are, just a reminder, that if you're ever going to opine about employment versus self-employment, you really need to look at two cases in particular. One is the ready-mix concrete case, and the other is Hall versus Lorimer on that basis. The first three arguments were dismissed without much discussion, as the upper tier felt that there had been no material errors in law in those areas. They focused on the final area. The upper tier decision, the final test, relates to whether there are any factors that are inconsistent with employment. The approach was to take each fact and consider if it was consistent, inconsistent, or neutral. The comments made were as follows: control, significant and significant with employment, work undertaken, neutrals could have been done as employee or self-employed. Views were his own, was neutral, but the fact that he was restricting his ability to exploit those views elsewhere was indicative of employment. Termination, this could only be ended by Sky, which pointed towards employment. Payment, the fact that Phil Thompson was paid a block regardless of airtime was found to be neutral. Main source of income was from Sky. This points into employment, as he was not getting income from a wide range of self-employed arrangements. On that basis, the conclusion reached by the FTT in this context was seen to be reasonable, and the appeal was dismissed. On that basis. Statutory residence test. So it is probably a tribute to the statutory residence test that, unlike other areas, very few elements have come to court in terms of SRT. And here, A, taxpayer versus HMRC, interpretation of exceptional circumstances for the purposes of the SRT. You can disregard certain purposes of SRT if in for exceptional circumstances. Why is that important at the moment? Well, obviously, with the trouble with the Middle East, I can expect lots of people saying, I had these exceptional circumstances, which meant I had to come to the UK. We'll be interested to see what happens there. This taxpayer was in the UK for 50 days in 15/16, which was 5 over the allowed 45 limit. She argued that she was supporting her twin sister who was suffering from alcoholism and depression. Her twin has 2 minor children, and she had to find appropriate care for them. The FTT found that the time spent was due to exceptional circumstances. That was overturned by the UTT, which famously said alcoholism is part of a normal condition and therefore it's not exceptional. Lots of people are alcoholics. The other question that came up was whether a moral obligation to support family did qualify as exceptional circumstances, and A appealed to the Court of Appeal. I think one of the reasons why HMRC was really peeved was that there was some really unsubtle tax planning. She was a shareholder in a family-owned company. And I think she left for the Republic of Ireland on the 4th of April. And the following year, she got a special dividend of, I think it was about 8 million quid, which meant the tax was at stake of 3.2 million if you remained non-resident. And I think HMRC thought she was taking the biscuit there, and then looked to challenge her, saying, well, you were a resident because you were here more than 45 days. She obviously, looking at the connections we looked earlier on, she got to the threshold of 45 days as a leaver. She was there 50 days. Coming in the chat. So A appealed to the Court of Appeal. So the first thing that you do on that basis is establish. There's another chat. Is it a question? Yeah, excited if I get a question. No, not a question. First, establish what circumstances prevented the taxpayer from leaving the UK. Then decide if they were exceptional circumstances. In this case, the constraint was sufficiently compelling moral obligation or obligation of consequence. felt that illness of a close family where no one else to care for them was an acceptable constraint. The alcoholism and depression were not exceptional, as this was part of an ongoing illness. However, the need to care for and support the children did mean that this was exceptional and appeal was allowed. What is important in this case is the limitation um, what is the limitation of using exceptional circumstance? And they still said that alcoholism and exceptional were not, and depression were not exceptional, as this was part of an ongoing illness. So why, if you've got a relative who is in, I don't know, needs care, because they're old and so on, or have disabilities, that won't necessarily lead to exceptional circumstances because it's ongoing. Needs care for children did mean it was exceptional and the appeal was allowed. But it does show that people who are relying on the exceptional element will need to think very hard before using it, because HMRC has taken a line which has not been supported by the courts, but it's not to say that the courts are being over generous in this area. This is the Harry Potter Rupert Grint case. Rupert Grint, playing Ron Weasley in the Harry Potter films. His father acted as financial manager. Company is set up with Rupert Grint as sole shareholder. But his father, on that basis, as sole director, with the intention that his acting services would be provided by the company. He transferred rights in relation to the films he'd made into the company, with 4.5 million being treated as a capital disposal on which entrepreneurs' relief was claimed. So this is some time ago, before it became BADR. HMRC opened up an inquiry on the basis that it fell within Section 773, Income Tax Act 2007, sale of occupation income, then issuing closure notice, bringing in the 4.5 million as income. Rupert Grint appealed. On that basis, what they said was the loan account was employment income. The particular piece of legislation is an anti-avoidance provision where rights to income are transferred in exchange for a capital sum, but can only apply if the main object or one of the main objects is the avoidance of tax. Argued that the incorporation was to provide limited liability protection and for administrative convenience, which was the commercial element. But the FTT found, unsurprisingly in my view, that the main reason was to save income tax, as had been stated by the company's advisors, and therefore the appeal was lost. Final one before coffee. So this is Michael Byrne versus HMRC. Carbon Managed Services Limited provided support services to legal company, with both companies being held by the same holding company. Mr. Byrne was a majority shareholder and director of Carbon. Carbon and the parent company were placed into administration in 2019 and then put into formal liquidation in 2020. 30th of January 2020. HMRC opened a compliance check subsequently, including Mr. Bernard being paid income shortly before administration commenced, but the no taxes and NICs have been deducted. So trying to sort of avoid that by putting the company into liquidation. HMRC believed Mr. Byrne knew of this failure, so issued a Reg 72 direction to him personally for the tax that was unpaid, but this was appealed. HMRC had to prove that there'd been a willful failure by Mr. Byrne relating to the deduction of pay as you earn. This hinged on whether he'd known the company had not paid over the tax, but he argued that he was unaware of the underpayment. Company had previously had a good pay as you earn record, and Mr. Byrne had no advanced knowledge of the administration. Once this happened, he had no authority within the company and so would not have been involved in the subsequent RTI return. The first tier tax tribunal found that he had not known that the tax was not paid, and so his appeal was accepted on that basis, which I think was quite lucky. Um, you could have easily seen it going the other way. One question which has come up: what would be your opinion on the whole forced to return to the UK argument as opposed to being one of choice, as the war and directly linked to the UAE? Well, I'm waiting sort of for an HMRC statement on this basis. Will they be as generous as they were 47 years ago? I don't know. The question would be, maybe you're forced to leave the UAE, but the answer might be, well, why did you come to the UK? So I think it will be interesting to see. I mean, this seems to be going on some time. It's not sort of 1 or 2 weeks. It will be interesting to see. I suspect there will be a statement by HMRC sooner or later on that basis. Okay. At this point, it's past 11 past. We'll take a 10-minute break now. Have any questions at this point? Can you hear me? Just want to check you can hear me. Somebody put something in the chat box. Only need 1 or 2 people to say, yes, I can hear you. Yes, great. Okay. So the next one I thought was of significant interest to people: accountants' compensation. What we're looking at there is accountants' compensation. Equity Advisory Limited and Craig Allen Mellor versus HMRC. Mr. Mellor was a chartered accountant who worked for Mr. Wall and the Opal Group of companies. He became a director but was never a shareholder. Company entered into interest rate hedging project, which resulted in them going into administration. Opal claimed against bank for mis-selling of hedging product with Mr. Wall saying he owned claim. Mr. Mellor incorporated new company Equity Advisory, was going to act as consultant for the claim in return for a contingent advisory fee as a percentage of the final proceeds, but Mr. Mellor and Equity agreed he would receive that fee. Received money and reported as non-taxable capital payment, but HMRC argued that it was actually really employment. Argued that it was employment income. And I think the element there is I think, what is the nature of income? If it's employment income, subject to national insurance and pay as you earn. The first decision made was the FTT had firstly decided it was income. Company was providing consultancy services which generated income, albeit that it was done by Mr. Mellor. Source of payment for Mr. Mellor was his employment with Equity Advisory as a reward for the services that he gave to that company. If it was not, as they argued, a payment for compensation for destruction of his career, then it would have been a termination payment. So on that basis, you're looking at the categorization, and on that basis, the appeal was dismissed. Here we've got a settlement payment comprising several aspects. L versus HMRC, anonymized case. L was an executive director with various components to their remuneration. One part was deferred cash and stock units, vesting over 3 years. 2 years later, in 2013, was made redundant and filed a claim with Employment Tribunal covering various aspects. Agreement was reached in 2014 in full and final settlement of all past claims. Tax was deducted other than for 30,000 covered by termination payments. L submitted a tax return on the basis that certain amounts relating to the Employment Tribunal claim were not subject to tax, i.e. they were not within, they're not from employment, they're arising from other areas outside employment. Accepted that sums related to incentive awards and termination payments were taxable. HMRC disagreed, arguing that other than payment for injury to feelings, all amounts were taxable. Um, so accepted the incentive awards but not were not taxable. And also they wanted beyond the 30K limit because they talked about anything, HMRC said, anything other than payment for injury to feelings, all amounts would be taxable. Just a quick reminder in terms of termination payments. The first thing you look at is it contractually required? Is it earnings from employment? That could be unpaid holiday, accrued bonus, um, remainder of salary, or now all aspects of payment in lieu of notice. They changed the rule to bring all pylon payments into charge would be taxable. You're left with the straightforward termination payments and payments other than for employment, including injury to feelings. The decision on that basis, the payments which were disputed were compensation being paid to the taxpayer for being deprived of the chance to continue in employment. Was not directly connected to the employment, as this employment not being fulfilled. So was not a reward for services, did not come from employment. On that basis, it was not earnings within the relevant legislation. That is a significant decision. It is likely to be appealed by HMRC because it could potentially open the floodgates to a lot of claims in terms of where you've not been able to continue your employment, you've been prevented from doing so. Therefore, the payment cannot come in from employment, and then potentially significant amounts would fall out of tax. And I think HMRC will not take this one lying down. Here are travel and subsistence schemes. So this is the Best Connection Group Limited versus HMRC, supplied temporary workers to clients, typically working 13 to 15 weeks within the 24-month temporary workplace rules. Employees had to notify when assignment extended beyond this point. Company had two schemes with regard to travel and subsistence for such workers. One was settled, so this appeal related to scheme involving HGV, heavy goods vehicle drivers, and industrial workers. Received a non-taxable payment, which was said to be under a dispensation. Dispensations, given that they were not they were abolished effectively, although you could use deemed dispensations potentially on an ongoing basis. This is 2016, they were abolished. Basic record keeping requirements in relation to the payments. Three categories of payments on dispute: mileage going to and from temporary workplaces, costs using public transport to temporary workplaces, which was paid at a fixed daily rate, and food and drink costs. Were adequate records maintained to justify um, um, the tax-free status of these payments? FTT decision on that. Various anomalies were identified on the review of records. FTT systems in place had defects, led to some mistakes. Notice the system made in relation to reimbursement of travel costs. The subsistence system was fundamentally broken, which, if you have a system that's broken, that gives you more problems than a one-off problem. Therefore, many payments had been incorrectly made. Onus was on appellant to show that a particular payment qualified but could not do so. Liability could not be transferred to recipients under Reg 72, as employer had not taken reasonable care to comply with PAY regs. Appeal broadly dismissed, though some subsequent discussions to be had regarding the quantum of the payment. Here's another case about earnings. Payroll Limited versus HMRC. MC had been a sole trader, then the partnership which was incorporated. He and his wife had 31% of the shares. Sons had 5%, and the SIP trust held the balance of 28%. An EBT was set up and the company contributed £800,000. MC applied for a loan of £800,000 and used money to buy wife's shares. Loan was interest-free, secured and repayable after 5 years. The wife loaned the money to the company the money. MC continued to receive the same salary and dividends, and a partial repayment of the loan had been made. HMRC argued this was disguised remuneration and taxable reward for services provided. The FTT found for HMRC and rejected the appeal. MRC Limited appealed to the upper tier. In the upper tier, disagreement about what was the trigger for the earnings charge, the payment to trust or subsequent loan. FTT had decided on the basis it was a payment to the trust that it was the trigger, then went on to decide, even though the loan, as on commercial terms, it could be a benefit. There was an error in law. MC had an obligation to pay £800,000 and no expectation, as in other cases, that the loan would never be repaid. Therefore, the payment to the trust was not earnings and appeal was allowed. What is important about this case is that the status of loans, people get a lot of elements on loans. And here the courts look at it, and this is the upper tier, so it provides precedent. What the courts are concerned about is this loan realistically being repaid? And they said yes on that basis. Genuine termination payments. A lot of people think, oh, I can get a genuine termination payment. Companies were involved with an LLP that promoted tax arrangements that involved the appellant companies. Both directors were LLP members. Part of a wider inquiry, company accounts were examined and HMRC found that 6 £30,000 termination payments have been made to directors. Oh my goodness. It's not exactly subtle, is it? It's a bit like I pay a salary to all my children of £12,570. It's not terribly subtle, is it, if they have no other income? So what the scheme obviously said is become directors, pay the termination payment at 30,000. Oops, why did you choose that figure? And it's all tax-free. The FTT found that no contracts and directors did not receive remuneration for corporate work. Resignations were on a voluntary basis. Only documentation on payment was a note describing these as compensation for loss of office. FTT, unsurprisingly, did not believe that was accurate. Payment were in recognition of past service and therefore taxable as earnings. And it's a good example that, again, there are too many people plaguing taxpayers with not necessarily get-rich-quick schemes, but schemes where you're saving tax for very little work. And frankly, most of them do not work. Any questions on that? A few other bits in the slides, but I thought I'd move to the budget update as tempus fugit. Budget update for employment taxes. So business national insurance, secondary class 1 NIC frozen at £5,000 until 5th of April 2031. And I think that is of interest from the point of view that, frankly, this has had a pretty big effect on employing people at the starter level, because the initial reduction from £9,100 to £5,000 cost businesses £615 for every person employed. With the other changes, this has had a significant effect on youth unemployment, which sits at 16%, which is higher, or certainly at the same level, probably higher than at the peak of COVID. NIC exemption for hiring armed forces veterans in their first civilian role, extended to hirings up to 5th of April 2028. So the first £50,270 worth of earnings for 12 months after hiring. Small profits threshold increased to 7,108. If self-employment profits are below that, you have to pay Class 2 NIC. And the Class 2 NIC increased to £3.65. The Class 2 NIC obviously is one of the ways of making sure that you've got 35 years of contributions or credits allowing you a pension. It's quite interesting. So it relates to what we've had before in terms of the FIG regime. Newly resident individuals can claim exemption from their foreign employment income for the first 4 years of UK tax residence. This is the capped at the small of £300,000 or 30% of qualifying income per year. So Section 690 ITPA 2003 is amended to specify that if the employer's best estimate of qualifying employment income for an eligible employee is more than 30%, it must be limited to 30% on the pay-as-you-earn notification form. So in other words, you can't take more than 30% in terms of OWR in the rules. On that basis, you can only apply for exemption from pay-as-you-earn under Section 690 on the basis of 30% or 300,000. The lower of the two, you can't get an amount, an exemption from pay-as-you-earn for an amount that would be higher than the regs would permit in any circumstances. Student loan repayments threshold for Plan 2 student loans frozen at 29,385 for 3 years from April 2027. There was something in there, but I've no idea what they're looking at the moment. Government will make changes to the way international mobile individuals are taxed, closing loopholes. I have not the foggiest idea what that means. I've not seen anything in any of the tax journals or others about an update on this, and who knows what this means. Answers on a postcard. I'm sure we'll find out sooner or later. Pension contributions. So one of the big issues that is causing quite a lot of controversy at the moment. Employer and employee NIC to be charged for salary sacrifice into pension schemes above £2,000. But if you don't make a salary sacrifice and you just decide to make large contributions into your pension scheme, that would still seem to be NIC free. So as an owner manager of a business, I can still shove money up to £6,000 a year plus any unused relief into my pension scheme from my OMB, and that still seems to work. This is an interesting one from the new Employment Rights Act, which is hoving into view lots of seminars about this, giving all sorts of rights to employees just when employers are thinking, maybe I don't need to hire anybody new because of either new technology or just uncertainty in the world. So the new Section 27BP of the Employment Rights Act 1996 gives workers in Great Britain the right to payment for cancelled, moved or curtailed shifts if they're on 0 hours. So let's say I'm with McDonald's on a 0 hours contract to produce burgers from 5 till 7 in the evening, and then they say, oh, because there is snow expected, we're not expecting many customers, therefore we've cancelled your shift. Under the Employment Rights Act, they've now still got to pay me that shift. And then the question is, does it come from earnings or does it come from employment giving me compensation? And what they've decided, not unreasonably on that basis, is that it does come from earnings. And therefore, to put it beyond all reasonable doubt, regulation, a tax will be levied on the payments made because of cancel shifts, and regulations will be introduced to confirm that the payments are earnings for purposes of Class 1 NIC. So therefore, you would expect that McDonald's will pay me for that shift that I didn't do, and they'll also be subject, there will be national insurance, and they will subject you to pay as you earn. Other updates in terms of budget. So student and postgraduate loans. So this is a big issue that seems to be coming up on a regular basis. You can see that there are now full plans how to make this really simple. Deduction at 9%, postgrad deduction at 6%, and of earnings above that figure. Of course, there is also the heinous rate of interest that students are paying. And you do wonder that if I was looking at family tax planning, I would be thinking about quite carefully gifts out of regular income or giving income producing assets to my children to avoid them getting into this student loan debt in the first place, rather than waiting till later on. This is an area of maximum issues on that basis. Prepare for new pay-as-you-earn responsibilities in labour supply chains. So new rules for pay-as-you-earn in labour supply chains involving umbrella companies come into effect 6th of April 2026. This is often used for avoidance in order to claim travel and subsistence. Agencies and end clients will be responsible for ensuring that pay-as-you-earn NIC is operated correctly, and liability for payment not paid by the umbrella companies, which have a nasty habit of going into liquidation when problems hit the fan, shall we say. Umbrella companies are reminded their primary responsibility to apply the rules correctly and pay the tax NIC. And workers are reminded their responsibility to check their pay slips using the online tool. What are the responsibilities on that basis? So perform due diligence on your whole supply chain. Find out what you need to do when you engage a worker. Consider adding clauses in your contracts with umbrella companies. Check pay slips to ensure pay as you earn is being operated on the full amount received by the worker. Be extremely cautious about working with umbrella companies that are offshore or offer financial incentives. I mean, it's back to the point that if they offer something that is too good to be true, it probably is. Check HMRC list of named tax avoidance schemes, promoters, enablers, and suppliers. Check out the umbrella company's details and returns filed with Companies House to make sure details such as its financial position, location, and trading history are consistent with what you've been told. So, it's a bit like, covers of cigarette packets, huge health warnings on that basis, and educate your workers by sharing information with them about tax avoidance schemes. So one of the criticisms in the Ray McCann review was that HMRC were not proactive enough in dissuading people from taking on dodgy loan arrangements. And so HMRC has gone on a bit more of a public information campaign to try and get people to be aware of the issues. There are sharks out there, as one might say. Don't necessarily go into the water with a shark around. Clarifying the optional remuneration arrangement rules. This is where they had the crackdown in 2017 on salary sacrifice arrangements. So HMRC has reminded employers of the OPRA rules, advising that promoters are again advertising ineffective schemes involving salary sacrifices in return for such items as grocery vouchers. Employers and employees could make costly errors if they fail to apply the rules, which basically says you tax them on the higher amount of the value or the amount salary sacrificed unless they fall into certain particular areas. As an OMB, I can give myself all these sorts of things and potentially get advantages, but you can't do it through salary sacrifice. So any questions on anything I've looked at? Okay. So I want to talk a bit about HMRC moving the goalposts on international NIC. Sorry. So on the 18th of September, HMRC updated their national insurance manual with guidance on the NIC treatment of earnings paid to internationally mobile employees. An internationally mobile employee is a person who comes from the overseas to work in the UK, leaves the UK to work overseas, or works simultaneously between the UK and overseas. Following a lengthy review, we don't know with who, we don't know the sources. So this is one of those rather unsatisfactory changes. HMRC seems to be changing the law without any authority to do so. This update to the guidance instructs employers to calculate earnings on which Class 1 NICs are payable on an apportionment basis, i.e. based on the portion of the payment that relates to the part of the earnings period to which an IME was subject to national insurance. What is the result? This means that HMRC will not accept calculations based on an IME's NIC position at the time of payment. So I would say to you, you're going off to Singapore. Remember, first 52 weeks, you're definitely liable to NIC if you've been seconded abroad and you were ordinarily resident in the UK. So you pay £100,000 bonus 50 weeks after leaving the UK. That would be subject to NIC, employer and employee. So that's 15,000 for the employer, somewhat less for the employee, but quite an expensive amount. So cash bonuses, salary, securities, income, taxables, general earnings on that basis. But if you paid it in week 54, you're outside the 52-week period, no NIC. So that was the result. You're either all in or all out. And based on exactly where you are, what I call bums on seats at the time of the payment. You know, a bit like playing musical chairs, and have you got a seat where have you got a seat when the music stops, or in this case, the payment made. What they've stated in Agent Update 135 is that employers should review their historical NIC treatment in respect of IMEs, and where not aligned with HMRC's published guidance, employers should resource payments for NICs where appropriate and make payroll adjustments for the past 6 years, potentially because the law is different in Scotland, potentially longer on that basis, and rectify under and overpayments. Because if you made a payment in week 52, uh, you would fully NIC. Week 54, no NIC. Well, what's the payment relating to? And it works the other way around. So let's say you make a payment in the UK coming from abroad where there's no NIC agreement in week 54 of being in the UK, then it's fully subject to NIC. In week 51, no NIC. But the point would be is what is the payment in week 54 relating to? If it relates to a period of non-residence or where you've got no liability when NIC, there could be an apportionment. So there's both an over and an underpayment situation. So where I come from Singapore to the UK, if I make a payment in week 54 of 100,000, under the old rules, it would be, or understanding, I should say, been fully subject to NIC, whereas now potentially most or all of it would not be subject to NIC if it's based on an earnings basis. The comment made is this is unexpected considering the lack of inconsistency in communications with HMRC on this topic over the years, and the length of time for which HMRC's position was under review. What the guidance does not address is fully detail their technical basis for apportionment, outline what payments they believe to have an earnings period and what is the earnings period, and recognise that another country may also have the right to social security contributions on the same earnings, creating a dual charge which is prohibited where a social security agreement exists between the UK and the other country. Um, Also, the guidance does not fully detail, um, as I say, doesn't detail these points, and therefore it could be challenged in the courts because this is, I think, HMRC making it up without having either gone through Parliament or or actually winning something in the courts. What is missing is providing any practical guidance to payroll operators on how to process earnings that were partially liable to NICs, or how to deal with NICs on payments made after a person has ceased to be liable to NICs, or outlining why it considers it has the right to ask employers to take retrospective action when net because net under and overpayments of NICs may cancel themselves out. Particularly for the employer where they may have underpayments of 15% or 13.8%, and overpayments on that basis. Implications is clearly a review that you will probably need to do on this basis, where you've done this bums on seat approach, and you need to take a pragmatic approach on that basis. IMEs coming to leaving the UK where there's no social security agreement point or where a payment of earnings is paid after a 52-week NIC exemption or continuing liability expires. You're going to have to look very much, it's going to be people who are moving to and from countries where the UK has no social security agreement, and that is still the majority of the world. We have social security agreements with the EU. We have bilateral agreement that is under the EEA Social Security Agreement, where we're under the Trade and Cooperation Agreement, we remain a party to that agreement. But it is also the case we have bilateral agreements with countries like India and America on that basis. So those countries, this should not affect it. It's countries like Singapore and Australia where we have no social security agreement covering contributions. Going to look briefly at attribution of income because I think that is important. Normally, totally in the UK, it's going to be totally attributed to UK earnings. But what if I have a scenario where I'm in Germany, then I'm in Germany and Switzerland, then I'm in the UK, Germany and Switzerland, then UK and Switzerland only, and then just the UK. Clearly, the issue is that you may have mixed sources of income, and it's important to understand what are the local pay-as-you-earn regulations on that basis. If I have share options granted, well, it's now 11 years ago since the UK worked on the basis where were you resident when the share options are granted. Since 2015, you have to work on apportionment. So, did part of the share option gain? Remember, it's not based on the actual position when you left the country, but on that time apportionment. So you would look at what is your position in those years between normally the grant and the vesting of the option when the option is capable of being exercised. So therefore, on that basis, you could have periods in Germany, Switzerland, UK, with withholding or tax obligations in each of them. If a bonus is awarded, where the big arrow down is, again, you need to look when did the bonus scheme start? And is it attributable to periods of non-residence or duties elsewhere, which could lead to claims for double tax relief and may affect your reporting in terms of that. Give an example, time apportionment for period of residence. Kirsty makes a gain on 3-year share plan of 30,000 investing period, 1 year UK, 1 year Germany, 1 year Singapore. The UK would be taxed on £10,000. It would pay, or rather, Kirsty would be taxed on 10,000 of the gain because 1/3 related to UK. Let's do the next opinion poll. Ooh, poll on that. Next opinion poll. Next poll. What was that all? No more polls. Sorry. Run out of polls. Okay. That must be it. Did them all quite early. As we say, tax and NI are not the same, but over a period, you are going to have to look at the multilateral social security agreements, bilateral agreements, countries like USA and India, and countries where there's no agreement, where again, you're going to have to look very carefully at the regs on that basis. Inducement payments, normally taxable on day one in exchange for starting employment, and the receipt, if it's an inducement payment, starting employment would normally be taxed on the first day of the employment. In terms of any reviews that employers should do at the end of the year, you need to review your current practices, take corrective measures as needed, processing payroll adjustments, repaying or collecting employee NICs from individuals, and adopt an apportionment approach going forward if you think that is required on that basis. And that would have implications in terms of tax gross ups where you've got tax equalised individuals, particularly if they're also subject to NIC equalisation. There is the apprenticeship levy and student loan deductions and corporate tax filings. The final thing I wanted to look at is something that's a growing trend, which is known as employer of record. What is it? So an employer of record is an entity that legally employs workers on behalf of another business. An EOR takes full responsibility for aspects of employment, including compliance, payroll, taxes, and other benefits on that basis. So what we're looking at there is the task that an EOR takes on vary from service to service and location to location. This is typically what an EOR handles. Compliance with local employment laws. An EOR will guide and support a business to ensure employees are hired in accordance with local laws in every country or jurisdiction and provide them with compliant employment contracts. As the EOR is an employer, the business can rest easy. Well, that's the idea if you're selling this idea, knowing that the legal ins and outs are taken care of. Onboarding new team members. Once a business has found a new hire, the EOR will onboard, managing the employment agreement and setting up all the necessary processes for the new team member to start. In terms of running payroll automatically, payroll and local taxes for both employer and employee will be fully managed in the EOR, and the business's team again will be paid and receive pay slips from the EOR. So the team members will receive payments and pay slips from the EOR. In terms of managing compensation and benefits, EORs often offer a variety of benefits, but these vary from service to service. Benefits can include health insurance, time off policies, parental leaves, and so on. And of course, in terms of coordinating and standardizing arrangements, an EOR may be a good idea. When an employee's contract is terminated, the EOR will handle all the necessary details because hopefully it'll be all in the same place. And then on that basis, let's look at the costs and other considerations, the cost benefit analysis of doing it. What are the benefits? So an EOR can also help with local regulatory compliance, with local experts handling all aspects of employment within the bounds of the local jurisdiction. An EOR can increase the company's flexibility when it comes to staffing, Businesses can use EOR services to hire international contractors on a temporary or project basis. This can be particularly beneficial for startup companies. The cost savings, the benefit of using an EOR is far less than the cost of setting up an entity in a particular country. That is the cost of doing it. A global employment service like Oyster can save even more by enabling you to build teams globally. Just imagine the cost of setting up entities in several countries worldwide. Well, they would say that. But a number of people do EORs, and it has become more popular. Paying team members in different countries can also prove to be more cost efficient, as what's considered decent salary by work in a certain country or city could be far lower than the expectation of workers local to your operation, or higher, depending on all the cost of living attributes. Other claimed benefits: faster expansion, the ease with which the right EOR can enable businesses to onboard team members, and the enormous pool of talent global hiring openings mean that teams can expand faster. A more diverse talent pool, building a global team will naturally make your business more diverse, adding a range of team members with different cultures and perspectives. Some people think that's a good idea. In summary, there are many advantages to using an EOR, and you should weigh up carefully the pros and the cons before making a decision. In terms of international reach, an EOR based in Spain, for example, can hire employees locally on behalf of a company based in the United States. The employees would work locally in Spain for the company in the United States, with the legal responsibility of employment lying with the EOR in Spain. And you can see why, with different employment laws, that this suddenly becomes quite popular. It can also save time and money in the hiring process by handling all the paperwork and red tape on that basis associated with an employee, which could be a major time saver. Q&A question: do you think EORs have good tax knowledge, or are they following a playbook? So on that question, I would say it really depends on each EOR. It's a bit like going to the accountancy firms. Some of them are good, some of them are not so good, some of them good in a certain area, not so good in others, and some of them you wouldn't want to touch with a barge pole. So my view is the best ones are selling themselves on the basis that they handle the tax elements. Before you do it, my view, go ahead and test what the capabilities are of these people and the organization. And you might want to pose them some situation questions and see whether they can answer them. Good question, Rebecca. So what is an employer of record versus a professional employer organization? So with an EOR, employees are not co-employed like they are with a professional employers organization. Typically, a PEO manages some HR functions like payroll, taxes, and benefits. Businesses that work with the PEO sign a co-employment agreement. The National Association of Professional Employer Organizations defines co-employment as a situation where both the PEO and the client company will be responsible for certain obligations of employment, while both parties might share responsibilities for other obligations and be an employer, but neither party is the employer for all purposes. Under this arrangement, the company and the PA both contractually share employer responsibilities. The disadvantage of co-employment, because the employee is split between the client company and the PEO, neither party is fully responsible, so you can see things dropping in between elements. This sharing the risk and employee responsibilities can be challenging, and in some cases have led to legal exposure, such as in the Stephanie Perez versus Dermatology Group, PC versus ADP case. in which the employee sued the company and their PEO for claims discrimination claims. It was the legal and compliance challenge to the PEO model that led to the employer of record services as an alternative. In terms of the advantages claimed for EORs over PEOs, where both services are employment solutions, that's where the similarity ends. Unlike a PEO, an EOR goes further than general HR outsourcing by taking on the risk of hiring employees overseas, while the client company focuses on its day-to-day operations. Of course, always the risk, even with outsourcing, you're not getting rid of your responsibilities in its entirety. But if you like, you are sort of outsourcing more and you're hoping that the outsourced organization is equipped to do the work. Disadvantages of VOR are obviously it will be more costly because you're outsourcing more and more risk is being taken on by the other party, the EOR. And if the EOR is employing them, then you're losing an element of control. If I look at employment record versus employer of record versus the staffing agency, what is the difference? The staffing agency acts as an intermediary between the talent and the hiring company. Their main goal is to support the client company in hiring the right candidate that matches the roles they're trying to fill. Some staffing agencies offer additional services such as advertising the role on job boards, running background checks, reviewing applicants and filtering for role fit, filing paperwork. On the other hand, an employer of record service only kicks in once an employee has completed the recruitment process. EOR services generally do not participate in the talent search and vetting process. Is it easier to open an entity in another country or use an EOR? Well, I think it depends on the complication of what you're trying to do, what you're trying to open, as to whether you consider an EOR. Some countries, obviously, for employment are more difficult than others, and it's important to look at that. If you look at the countries EORs are looked in Brazil, Canada, Philippines, Portugal, India, France, Germany, and the US, most of those countries, or not all of them, are well known for making it not that easy to employ people on that point. What about in the UK? Well, if you're setting something up, use an EOR, set up a local entity, or use an employer, a PEO, professional employer organization. What is claims is the EOR is a simple, low-risk option to hire talent in the UK, as it takes all that burden away. But the point that is made is you need to think very carefully of who you choose, just in case there's blowback, either in terms of legal issues or indeed reputation on that basis. So we're coming up to 12 o'clock. I just wanted to mention, so there are a few other elements in terms of EORs, but the final element I wanted to mention was the cost variances in terms of how expensive is it. And I think that what I would say is you really need to look at your options. Are you going to a complex area? How much help are you going to need? As I say, EORs are seen quite a lot where the rules in terms of local employment are really, really more complex, and where you can't just say, oh, I'll apply the UK rules with a few changes. They're too complex to do that. And I think that it's important to think about, to what extent are you comfortable in outsourcing this large responsibility? And I think it's important that you think about it very carefully indeed. My final comment is about EMI, which is Enterprise Management Incentive Schemes. So this is not a course about share schemes. But I would say that the changes in terms of EMI, every so often, share schemes are ignored for years, and then suddenly the government decides to do major changes. These changes are all positive, increasing the size of company that is eligible for EMI to 30 million of gross assets to 120 million, increasing the size of the total value of options that can be granted, valued at the unvested points to £6 million, doubling it, reducing some of the compliance burdens, means that EMI, I think, is going to become even more popular, particularly with medium-sized companies. And that is an occasion where EMI used to be governed under EU law because it was a selective tax relief. It no longer is, and the government has taken the opportunity to expand the scope of EMI. And I think that would be something on another occasion that you might find interesting to look at if one was doing a share scheme course in considerable detail about how you could use that. Because in any budget, the last budget was more filled with bad news than good news if you're a taxpayer. There are always silver linings, and the EMI was the big one, in my view, for this year. And certainly, if I was looking at incentives, I know quite a few of you looking at EMI. Can I expand it? What can I do? You can also make the term of the contract 15 years rather than 10. So on that basis, I would be thinking quite hard about EMI schemes in the future, but that's really for another course on remuneration. Thank you very much indeed. I hope you found that interesting and that, managed to keep going despite the throat and the cold. And I hope that you found that an interesting subject. And I hope you have a great weekend exploring wonderful places. Like this is Stourhead in Wiltshire, fantastic place in both the autumn and the spring. Otherwise, thank you very much indeed. And I look forward to seeing you at some point in the future. Thank you very much again for K3 for hosting this. If you want our contact details, either for Marie or myself, they are on the board here. Thank you very much indeed.